The broadcast is now starting. All attendees.
Welcome to Weekly Option Trading, Weeklies and Earnings. I am Mark Sebastian. I am the founder of Option Pit. That is me on the left. I'm not the redhead. I was a trader on the SKEW for, about 10 years. After that, I left the floor and I started Option Pit. Option Pit is a education and consulting company. We work with retail traders, teaching them how to trade like professionals. And we work with hedge funds, money managers, people like that to help them understand, have an understanding of how to implement option strategies. In addition, I do manage a little bit of money in the hedge fund business myself, but we're not here to really talk about that. We're here to talk about trading. So what are you going to learn? We're going to talk about what traders need, how the weekly options work, how to use earnings to set up trades. I'll show you kind of a trade I like, ways to take advantage of weekly options, and what I say is the best trade for a weekly option. All right, that does not have earnings. So we're going to cover a lot of ground. What do traders want? All right. So, I got to thinking about this, and, the simple answer is traders want to make money. That's very easy, right? But how do traders really want to make money? What is the smarter way in which they're going to do that? Well, let's think. It's all about what they need. So traders need flexibility. They need the ability to get in and get out. That's one of the things I really like about not being a market maker anymore is the amount of flexibility I have. It is, when you're a market maker, you kind of get forced into your positions. And when you're not, like you guys, you can kind of put on the things that you want. And that's what I think is one of the best parts about you guys and now me is the ability to kind of do what I want. All right. What else do you guys need? You want internal control. Not internal. You want control. You want the ability to control how and when you're trading. The ability to control your ins and outs. The ability to manage your position. Again, back in the day, I did not have all this much control as you might think. I kind of got stuck with what was put on me, unfortunately. And then what else do you guys want? Speed. The one thing I will say is that the less time you're in a trade, the more likely you are to make money. I've always found that to be true. So the faster you're in and out, the better. All right, so what do traders want? When I was a market maker, we had 6 expirations in the equities and maybe 10 in the indexes. We had the front 3 months, so we would have had April, May, and June. We had a contract that was maybe 6 months out, maybe one that was 10 months out, and then we would have 2 leaps. So at most, we would have maybe 7, but usually more like 6. In the indexes, we had about 10. We had little control, flexibility, or speed, right? If somebody sold me something in May, guess what? I was stuck to it. There was nothing I could do against it. Now, we have a ton of control. We have the weeklies. And weeklies are the best. This is Apple options from the beginning of March. And notice between March 2nd and July, there were 11 expirations listed at the beginning of March. There was one every Friday in March and the first 3 expirations in April. 1, 2, 3, 4, 5, 6, 7 weeks in a row, and then May, June, and July. I mean, that's just incredible. All right, in the S&P 500 in March, all right, there were as many as 4 in a week. March had 14 expirations. 14 expirations in March. You know how many trading days there were in March? You know how many trading days there were in March? about 20. So there was literally almost an expiration a day during March. That is just incredible that what you guys can do now in the indexes. All right, so why weeklies? To start, having so many expirations gives the trader almost complete control and flexibility in a trade. I can trade before or during and after. I can trade earnings, an event, an F-day announcement, economic activity. I can trade before it, I can trade the date of it, or I can trade after it. I don't actually have to decide what I'm going to do. I don't have to, back in the day, so we're going to look at some stuff, but there's a lot of earnings next week and a lot the week after. So like Apple has the earnings 2 weeks from now. We'll talk about this in a second. Back in the day, I would have only been able to trade May against it. Now, all these weeklies, it's amazing. In SPX, there's almost dailies. All right, the thing weekly options can give the trader that is most valuable is that speed. And that's decay or lack of decay. Gamma. So the things to think about with decay is that it's exponential at the money. If I go a little bit out of the money, they do, except for when they don't. Right? Exponential. At the money, they lose a lot of speed. They lose a lot of money fast. When you go a little further out of the money, the decay actually becomes linear. And then the cheap options take forever to decay. And let me show you this, just if you don't believe me. Here's SPY. Right? These are the April 13th. So these expire tomorrow. Okay? And we're trading 266. As of at the close of business today, there was a bid for the 249 puts. The 249 puts, think about that. You know how big of a move that would be? So these teeny cheap options take forever. The 260s that are $6 out of the money are 8 cents. And on the upside, $50 out of the money. 272.5. 272. $6 out of the money. 2 cents, 3 cents. There was someone willing to pay 2 cents for the 272 calls yesterday. Do you think that a week ago that those would have had that kind of value? No. No. So as you move away, and here's a nice example. As you move away, in the money now, the money options are much more linear. You see how these out of the monies, the decay actually slows down a little bit? Meanwhile, the at the money options have this exponential drop. That's the key. All right. So what are weekly options really good for? We're going to cover 2 of them. Put selling strategies, they're awesome for. I run a letter called the Weekly Wheel, where we basically sell puts, take delivery, and then do cover calls against them. They're good for covered call writing. Again, part of my weekly wheel. They're great for earnings. They're amazing for earnings. And they're good for advanced income strategies. So we're going to look at earnings and income strategies. All right. As I stated, the weeklies can give us great look at earnings. All right. So the best way to use earnings and weeklies is to measure the straddle. This is the first key. All right. A straddle is a cost of an at-the-money call and an at-the-money put together. All right. The combined value is what the market is expecting the underlying to move, plus a tiny bit of risk premium, but it's pretty much the market's best guess of where we think the underlying could go. All right. And here, I'll show you historically. So Delta had earnings this morning. DAL. All right, you see that earnings this morning? Get a chart up here. I want to show you this. You guys will like this. So here we are. Yesterday it closed 51.5 on the nose. The market was pricing in 95 cents plus 97 cents. So the market was pricing in about a $2 move. A little less, call it $1.97. All right, well, let's take a look at today's chart. At its peak, it got to 53.64. A little over a $2 move. It settled the day at about $1.50. And it still has one more day left to it. So there's still a little bit of movement left in that straddle. But for most of the day, it was almost dead on. You had your little bit of a dip here when the market sold off. But most of the day, you can see that straddle was basically dead on. Everyone understand what I was looking at here? See this, here, let me bring this to the top. Right here. Right here. These expire tomorrow. Here's the call, 94 cents at 96. And the put is 94 at 99. So really, we'll just call it 95 cents and 95 cents. That's $1.90. And the market closed 51.47. So almost exactly 51.5. And then if I look at my tick chart that I just had, you know what? It was on the open, it was 53.15. So call it 25 cents shy. At its peak, it was maybe 25 cents better. And we settled about 40 cents shy. At the end, if we have time, I'll look at an earnings play, guys, if you have one in mind. So I want to know what's going to happen. So JP Morgan reports tomorrow. All right, the stock is trading 133.37. That is where it closed. All right, so that's going to put it, we're just going to round this to make my life easier to 113.50. All right, so I don't have a 113.5 strike. So what do you think I'm going to do with this earnings strangle? This earnings straddle? What do you think I'm going to do? I'll tell you what I'm going to do. I'm going to take this guy, which is the 114 calls, and this guy, which is the 113 puts, and I'm going to add them together. That is going to be $2.15. Then I take how far away 113.5 is from 113 and 114, which is 50 cents, and I add it to it. And that's my earnings straddle. So the market is looking for a $2.65 move tomorrow. A $2.65 move tomorrow. That is what we're looking for. Not bad. So how am I going to think about that? Well, I'm going to start and I'm going to look historically. How much were we expecting the underlying to move in the past? And I'm going to look at this pink line. Well, the earnings straddle in last July, it ranged from 297 to 131. In last October 2017, it ranged from 286 to 92 cents. And in January, it ranged from 270 to 379. So would you say that my range is about normal, or a little high, or a little low? $2.65. What do you think? And obviously, I would go back and look at more of these. But just based on this tiny data set of 3, does $2.65 seem normal? Yeah, it seems like it's about middle of the road. It seems about middle of the road. Nothing great, nothing. So it's not overly expensive. It's not overly cheap. All right. So now let's talk about how do we play earnings. So here's a question for you in earnings. Do options usually win when they win? Do options usually win when they're sold on earnings? So do earnings strangles and straddles and double calendars and credit spreads and puts usually win? If you did 1,000 trades, would most of your trades win? What do you think? Yes. Yes, correct. Yes. Most of the time, a preponderance of the time, not most, preponderance of the time, that the premium on earnings is too high. You saw in Delta, it was a little too high. Now, here's a question. Do options make money when they are sold on earnings? Do you understand the difference between if I did 1,000 trades, would I usually win, versus if I did 1,000 trades, would I make money? They're two very similar questions. So if all I did was sell options on earnings and I did it 1,000 times, would I make money? And the answer is no. Believe it or not, I would be a small loser. All right? You'd be a small loser if you buy as well. But the fact of the matter is that, yes, you do win most of the time, but when you're wrong on an earnings sale, what do you think happens? What do you think happens when you're wrong on an earnings sale? It tends to move more than you expect, right? So even though you win most of the time, you don't end up making money if you do 1,000 of these. So the fact of the matter is, income plays and straddle plays, both buying and selling, are crapshoots. Over time, you don't make money if you buy, you don't make money if you sell. If you're trading a non-directional earnings play, you will not win. All right, I knew this guy. He was trading these Google strangles and made money and made money and made money, and then he lost all that and more on one earnings. So the only way to trade earnings if you really want to. Most of the time, I kind of sit out earnings. I like trading in front of them, and I like trading after them. I don't normally trade into them. All right? But if you are, the best way to trade is to trade for direction and use SKEW and volatility to trade a butterfly, or alternative, use term structure to build a calendar. I'm going to show you about the butterfly. I'm not going to talk about the calendar today. So this is SKEW. SKEW, this is the April 13th SKEW for JP Morgan. What SKEW really is the relationship of all the strikes to each other. It's the relationship of all the strikes to each other. So how expensive is at the money relative to out of the money up and out of the money down? All right, term structure is how all the different contracts are interrelated. So what I would be doing is looking at kind of where do I want to buy and where do I want to sell? Well, I know I want to buy here, and I don't want to buy here. Probably want to buy here, sell here. So let me show you what this looks like in actually when I'm looking at the trading platform. All right, and this is if I was bullish JPM. I would lean bullish JP Morgan. So you can see my theoretical is 99 cents. That's about a 61, and I want you to look, here's the vol right here. This is vol, 61.38. And then I'm selling two of these at two of the 116s at, let's call it 37. It's almost a 60 vol. So I'm getting, let's say, 60% out of it. I almost want to be getting... I mean, that should be worth 37. There you go. So I'm buying 61.38. I'm selling 60.5. I'm going to do this for fair value. 61.50. I'm selling 60.5, and I'm buying the 118s for 58, just to make things easy. All right, now how do I know I like this trade? All right, I'll tell you. It's called getting a vol credit. And this is maybe a little advanced, but if you want to trade earnings, you need to be a little more thoughtful. So what I'm going to do is I'm going to take 61.5 plus 58. That is how much implied volatility I'm buying, 119.5. This is a trade for tomorrow. What would you say when the future prices are not known? What I'm telling you is the future prices are currently not known. All right, this is implied volatility. We're looking at, this is the closing quotes for today. JPM reports tomorrow. All right, my gut says I think it's going up. And if I was going to build a trade, I didn't do this one, but if I was going to do one, this is what I would do. All right, and what I'm telling you is 61.5 plus 58, you get 119.50. And then I get to sell 60.5 vol twice, which is 121. So I'm taking in a 1.5% volatility credit. To me, that is edge. That is, so there's a tiny bit of edge in this trade for me. All All right, so how would I build this trade? All right, so you have your wings and your thorax. The wings are the edges, the thorax is the middle. Your short thorax should be beyond the straddle price. Should be beyond the straddle price, preferably. All right? Sometimes not. Why does making money have to be this hard? If it was easy, everyone would do it. Your long wing should be inside of the straddle, and try to get a good risk reward for your opinion. Make more. If you're going to trade earnings, you need to think, folks. Make more if you were right than you lose if you were wrong. So with JP Morgan, looking at this trade, maybe made a little bit of a rule break, but with my 116s. But I also need to get like some actual value, right? So it's trading 137, 130, 113 and a half, and the straddle is 265. So technically, these 116s are right at the straddle price. All right, my cost on this is about 35 cents. And it's $2 wide. So my risk kind of looks like this is not exactly right. Because they're not giving me tomorrow's expiration. So I'm risking 35 to potentially make, I think, 70, 80. And the nice thing is, if it doesn't move, I will make money. All right, why? Well, because the 114s will be worth more than 35 cents. If it rallies, I'll probably make money. The only way I lose is if it drops. So I've got 2 ways to win and 1 way to lose. That is how I structure that earnings trade. Right? I want 2 scenarios to win, 1 to lose, and my risk reward is good. I'm risking 35 cents to make $1.65. All right, hopefully we'll have some time. I want to have a little time to look at another one here shortly. We'll build a trade around one of your guys' ideas. All right, so try to get good reward. All right, so now let's talk about some advanced things that you can do with butterflies. Again, awesome for calendars, awesome for flies. Let's talk about butterflies. So an iron butterfly, as you know, is simply a straddle that is hedged. It involves the selling of an at-the-money call spread and an at-the-money put spread. This is kind of a runaround back to our the earlier slides where we talked about decay. And the net creates a tightly defined high-yield area for the spread to profit. That's an iron butterfly. All right, so butterflies are the best way to harvest premium out of a weekly trade without taking a directional premium. And they're actually really good to put on ahead of earnings. And then you take them off the day of earnings instead of holding through earnings. Try putting up on a butterfly the Monday before earnings and taking it off on earnings day before they announce. The crazy thing is how short these things have to be held. I talk about that speed. Butterflies are so fast. Pigs get slaughtered. Smart pigs have roast beef. All right, and I want to tell you a story. All right, I'm not the biggest guy in the world. All right, I'm about 5'9", maybe 170, 175, something like that. Maybe 5'8", 180, something like that. Who knows? All right. But anyway, I was a small kid in high school. All right, and my dad actually was a Green Beret, tough guy, went to Vietnam, blah 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 blah. All right. And, you know, I'd been getting kind of bullied a little bit. And he pulls me, and I'm telling him that I'm a little scared. I don't like what's going on. And he says, well, you know, son, I never want you to fight. It's a waste, stupid. But if you're ever really scared for your safety, here's what to do. All right. And you know what he told me to do? What do you think he told me to do? Well, you got half of it. He said, punch the bully in the crotch as hard as you can and run away. All right, he was assuming it was a guy. And that is the way butterflies operate. Options are a bully. You want to punch them, get in, get out. So I want to show you this is an old apple fly, but it's a great example of how you can make money quickly. So I want to look at this split strike. You are selling the 127 puts and the 128 calls. You're buying the 130s and the 125s. All right, so on the wings, I'm paying 61 cents. That's the ask on the 130 calls and the bid on the 125 puts. On the thorax, I'm getting about 184. Call it 90 and 94. All right, so net, what is my net? I'm collecting a credit of $1.23. All right, $1.23, my risk is 77 cents. So if I do a 10 lot, my risk is $770. All right, well, I want to show you the next day. Let's take a look at what happens. Well, my 128s I'm short are worth 50. My 127s I'm short are worth $1. They're worth $1.50. So the straddle lost 34 cents. My wings, right here, and right here, are worth 45. They lost 16. So instead of $1.23, it's now worth 105. So how much did I make? I made 18 cents in a day. So let's think about that. All right, the margin on that weekly fly was 77 bucks a contract. A 10 lot would be 770 bucks. In one day, that makes 18 bucks a spread. Yeah, I didn't do 1,000 of them. That's $180 in one day. That's 23%. All right. In a year, that's 45 grand. Now, you would never win that many times in a year, right? You're not actually going to make 45 grand. But my point is, with weeklies, you can turn a small portfolio into something that acts like a big portfolio because you have this opportunity to churn a lot. You can do a lot of trades. That is true. You make 180 bucks. All right. So you have the ability by doing these weeklies, if you do 1 to 2 trades a day or 1 trade a day that's really good and you win more often than you lose, you're going to be able to create a portfolio with a small amount of money that creates a lot of income. So it's not obviously Vol-Risk Premium is overpriced. There is an edge if you're smart about it. And again, 1 hit, run. All right, now pick your spots. And here's why you get out after a day. This is 2 days later. And I want to show you that my thorax is worth $1.88 and my wings are worth 48 cents. So my 18-cent winner became a 17-cent loser if I waited an extra day. Don't get greedy. Don't get greedy on these trades. All right? So when picking a butterfly, the key is to think about what's going to happen in the next 2 days. What is going to happen between now and then? I don't care what you look at. Candles, Bollinger Bands, news, whatever. If you weren't a butterfly for more than 2 days, you are wrong. All right, so in summary, weeklies provide everything you want. Learn to use weeklies to analyze earnings. They're great for flies, and there's a lot more weeklies can do. And speaking of weeklies, we just finished this up. It was a great class. Mastering Weekly Options. This is a 4+ hour, 3-part class. The first part is on a lot of fundamentals and on a deep dive into really understanding how weeklies work. There's a then section on directional trading and a section on calendars and a section on butterflies. So it's about 4 hours long. In our store, it's $297. You can buy it for $147 if you go to optionpit.com/weeklies. Use code CANDLE70, lowercase candle, integer 70, to take $70 off that price. So $77 for the class. And you'll get 1 month of Option Pit Live, that is our chat room, for free. All right. This is an incredible class. And we charge $125 for Option Pit Live. You can cancel at any time. You might not want to. All right. We charge $125 a month for Option Pit Live. If you do roll your subscription over, it'll only be $97. And if not, you get this awesome course for just $77. Optionpit.com/weeklies. All right. Do we have any questions? All right. Did anybody have a stock they wanted me to look at? Can you post the website to sign up yet? Yep, www.optionpit.com/weeklies. And then use code and if for some reason the code gives you issues, I'll rebate the $70. All you have to do is email me and say, hey, you said you'd rebate the $70. And my email is mark@optionpit.com. What's the software I was using? It's called LiveVolX. My clients have preferential treatment there. Preferred pricing, whole 9 yards. Not that different. You don't have some of the risk analytics. How about Toss? LiveVol is way better than Toss. All right, I will look at earnings real fast. You got to look at IBM or Boeing. I've gotten both of those suggested. All right, IBM it is. I'll tell you, I already set up an IBM trade. IBM is garbage in my opinion. I think they still have huge problems. It busted out over the 50-day, but the 50-day is still falling. The vol is really high into earnings. I'm going to pull up regular April curvature. You'll see how steep the April. See how crazy that downside curve is? So what I want to do, and the at the moneys are the cheapest things to own. So what I set up for me was I did the April 157.5 puts expiring next week. I'll probably sell this before earnings. I paid $3.40. I sold these guys at $1.10, and I think I paid 30 cents, maybe 34. So I'm off a little bit. But I like this guy as a spread. Looks like that great risk reward. Great risk reward. So if it sits, I win. If it drops, I win. If it rallies, I lose. But if it drops, I win. I'm going to win more than I lose. That's how I love to set these trades up. All right, folks, once again, go to optionpit.com/weeklies. Use code CANDLE70 to get that discount. Discount code is going to be good until tomorrow, until through Monday. All right, folks, have a great evening.